Good morning, guys. How are we today? You good?
Very well, thanks. You leave yourself?
Very good indeed. This almost feels weird, right? Because it's not a Friday. This is a
No.
Thursday webinar, and we are renowned for our Friday webinars at 10 a.m. But it's definitely not Friday, so I'll try my best at the end to say, have a lovely weekend, because everybody will be thinking, we've got one more day, mate. What's going on? Um, Thank you, everybody, for joining us today. Just give us a quick hello in the chat. I know Jade will probably be in here saying good morning. There she is already. I've just opened it up. Good morning. At least I know everything's working fine. I'm going to kick things off quite quickly today because I can appreciate this is going to be an in-depth, quite a conversational webinar from the guys over at Aspen today. Thank you and good morning to everybody saying hello in the chat. At least we know it's working. So welcome to another Club Live. I hope you've all had a great week. As always, please do ask any questions at any point. Don't worry about waiting until the end. If there's something that you're looking at that you want to get an answer to, just fire it in the chat section. We will be on hand to answer those. Two ways. You could do it in the chat where you're typing now, or there's a Q&A function if you want to keep things a little bit more anonymous. When you exit today's webinar, there will be a feedback form that pops up. Please take 2 minutes to give us your feedback. It's very important to us. It's how we improve and how we continue to develop the way we deliver our content. But also on our feedback form, if you do require CPD from today's session, do let us know. There is a section on the feedback form where you can request your CPD certificate. So with that being said, let's get straight into things. Behind the club is myself, Amanda, Lewis, and Jade. I've popped my QR code on the screen today. Reason being, we do create a lot of content off the back of today's session as well. So we will create an article that I'll post on my LinkedIn feed as well. We create little short reels. And also, if you're not able to attend any of our previous webinars or future webinars, we do create articles and content off the back of that as well. So if you want to stay up to date with what the club and what we're up to, give us a follow on LinkedIn and you can stay in tune with what we're up to, really. So that on the face of it is who the club is, but we do have a significant backing with all of our wonderful collaborators. The support and guidance that these firms give, not just to us, but to our club members as well. Great content that's also delivered by some of these awesome collaborators. Very much like Aspen today, Lewis and Andrew are with us from Aspen and they are delivering today's session. So thank you all very much for coming along to today's session. Just briefly touching on our community outside of the club, we want to build a community that works for absolutely everybody. Our WhatsApp groups are a very good source of information. We have separate groups depending on the role that you play within your business. So whether you're an owner and then an advisor, power planner, ops manager, whether you're looking for a particular study group, please do join our communities. Again, you can let us know within our feedback form at the end, depending on what group you want to be a part of. Let us know and we'll get you in there by the end of the week. But look, if you want answers from other people playing the exact same role as you in the industry, there's a group for you that can support you. Club Lives, as you know, expert-led, practical and CPD accredited. And our podcast, hosted by Lewis, is where you can hear the voices of other leaders in the industry, other owner managers that are running firms. You can hear the highs, the lows, the good, the bads, the uglies, and you know what they've done to get to where they are today. So we've had some amazing people on our podcast, all available on your Amazon, Spotify's, and iTunes, and whatever else, wherever else you listen to your podcast. So do have a look for the Financial Planning Podcast on those platforms. Just a quick look as to what we've got coming up in our live events. We're with Advisory AI on Wednesday the 22nd. So that's next Wednesday. The guys keep throwing me off with the days that I'm doing webinars, right? So next Wednesday, I believe as well, another curveball, it's at 10:30. I mean, I don't know what they're trying to do to me these days, but we're going to be exploring why most AI tools don't fit advice firm workflows, the risk of templated-led AI versus firm-specific outputs. We are then, along with ISIO, on Friday, the 1st of May. Bonds that aren't boring. So the role of asset allocation in driving long-term outcomes, why diversification is often underused in retail portfolios. And then fast forward to Wednesday, the 6th of May, we are with the incredible Kate at Timeline. So we're going to be exploring what drives Timeline's portfolio performance and how tech supports scalable investment processes. So building consistent outcomes at scale. So again, some really good sessions there lined up. They're all an hour long, all CPD accredited. So if you do have time, very much how you registered for today's webinar, you can register for any of our webinars in the same way. We also have a big library of webinars now, so you can revisit any of the webinars that Aspen have run with us previously. I think we're maybe 4, 5, 6 deep now, which is really good. So there's loads of content. We've done building a scalable CIP, CRP. We've done quite a bit now. So there's lots of content for you all to go back and revisit. So yeah, really leading on to that, joining us today is Andrew, who is the founder and chief executive, and Lewis, who is head of distribution at Aspen. Andrew founded Aspen back in 2019 to help drive the wealth management industry forward, and is now one of the fastest growing providers of managed portfolios in the UK. Lewis leads up the distribution at Aspen, working closely with advice firms to help them adopt and implement their MPS solutions effectively. What I've done is I've trimmed down the introduction, because I know you guys do an introduction as well, and we normally say the exact same stuff. So I've tried to put mine back a little bit so that you can elaborate a little bit more, maybe. As you all know, we ask some questions when people register for our webinar. So a quick snapshot of who's in the room, mainly IFAs and planners. What's clear is that most firms are still relying heavily on cash and simple low-risk solutions for shorter time horizons. So there's a real appetite to move beyond, to really move beyond that. And people are looking for better strategies to really balance liquidity, risk, and return. But there is still some uncertainty around what good looks like there and how far to move away, or how far to move away from cash, really. So overall, a clear opportunity for more practical guidance in this space. Guys, how are you finding things at the moment? Are you getting asked a lot about short-term investment, short-term horizons?
Yeah, it's definitely coming up. It's well, but I say far more than it ever has done before, I believe.
Mm,
It's probably a couple of things that have helped with that. And obviously, look at the last few years, obviously, interest rates have obviously risen quite dramatically. And that's really made some of the shorter term options available for advisors to use now much more attractive than they were, say, 10 years ago. So you've got a bit of that. And also, as an industry, we've all moved. I mean,
mm,
even this is the financial planning club. This isn't the financial advice club. People are
mm.
talking about planning now more than ever. And all the people that we speak to on a day-to-day basis say the same thing to us, which is my clients are coming to us with goals, objectives that we're trying to help them meet. And there was, I think, a bit of a gap between the conversations that financial planners are actually having with their clients and the solutions in the market that are actually on offer. So they're really struggling to take those clients' needs, goals, and objectives and find a solution that really aligned with those. So it's not as simple as just filling out a risk profile and saying to a client, right, you're an 8 out of 10, away you go.
Yeah.
And that's not a realistic conversation that people are having. So yeah, it's definitely coming up more and more. But there's loads of attractive options now out there, which is then making it also confusing as to what do I use? What do I use for my clients who maybe has some shorter time horizons, whether that be 1 year, 3 years, 5 years, whatever it may be.
I can imagine it's also down to what's going on in this wonderful world of ours at the moment,
Yeah,
and the uncertainty of the market. You know, people might be a little bit more cautious to tie things up for their normal time horizon, and probably looking for something more short term, just to maybe ride the wave a little bit before they tie things in, you know, a little bit longer, would you say?
massively.
Yeah.
I think this has been, we've labelled on for quite some time now. Financial anxiety is such a big thing.
Mm,
And if we can help people in terms of the advisor that we work with and their clients, we can give people peace of mind saying that we've got solutions here that you can, like you said, tie up money that's less volatile for X number of years. Hopefully that means that advisors can sleep easier at night knowing that their clients don't have to worry. Clients can sleep easier at night thinking actually, no matter what's going on in the world, if I do need money, I'm not really affected by this in the short term.
mm.
So yeah, financial anxiety is a big thing. And especially over the last 5 years, I mean, all of the various different wars and conflicts that have been going on, and especially this year, seems to be ever present now as well.
Absolutely, absolutely, guys. I will stop sharing my screen. You should both have permissions to take over. The floor is yours. If you need me for anything, I'm always on hand as always.
Thank you, Lee.
Great morning, everyone. Is that working?
Yep.
Uh,
Absolutely, mate.
Okie doke. Yeah, thanks everyone for some time this morning. Great to see so many people on. Really looking forward to this session. As Lee said, questions along the way are more than welcome. It makes the whole session, I think, much more useful for everyone. So I'm very happy to Lewis and I will keep an eye on the chat and dip into those. If we only get to slide 2 and it's all Q&A, that's fine as well. So we do have some slides that we're going through, but as I say, interactivity is very welcome. So just a couple of intros. Obviously, Lee's kindly done this already. So I'm Andrew Spence. I started the Aspen business 6 years ago. I've been in wealth management for about 20 years, sort of end to end of big firm, small firm, traditional private client to starting sort of running MPS back in 2012. So reasonable experience across the field. Also head of fund research for Williams de Brough in London for a period of time. So I saw a lot of solutions, across the the lower risk to the higher risk, and all the options available in terms of liquidity solutions over the years. So looking forward to kind of discussing the pros and cons of some of those. Joined by Lewis this morning. Lewis, if you want to do a quick intro.
Yes, nice to meet you all. So, as you mentioned, I'm head of distribution for Aspen. So, I joined the business originally as employee number 4. So, I've been here since the start and when we really started to grow the business out. And prior to that, I've worked at various different companies, both on the intermediary side, so working with financial planners, but I've actually also worked on the private client side as well, which is why for me, I really wanted to work somewhere that really understood the conversations that financial planners and advisors were having with their clients and really wanted to make that positive change to give advisors what they actually need to support those client conversations. So yeah, a wealth of experience, seen it all, and yeah, support, as Andrew mentioned, supporting all our clients across the UK, but especially in the south of England as well.
Thanks, Lewis. I believe we are starting with a poll. Not
Yeah.
sure how this is going to work. Hopefully it works.
We're going straight in, yeah?
Nice
Yep.
one. Yeah. So, starting with what is your current approach to managing clients with varying goals that include shorter time horizons? So the options are invest all wealth into one risk-rated solution and draw down accordingly, use the bucketing approach, align different investment solutions based on goals of the client, or something else.
How much of this would you say comes down to the tools firms have and the advice process itself?
I think
Massively,
a
yeah.
lot comes down to the tools, the solutions available, and things, Lee. Traditionally, we'll go into this. Traditionally, we're used to just, 5, 7 risk-rated portfolios, I think. And, if you're low risk, you go into a low risk portfolio solution. And, as we've seen in the last 5 years, sometimes they're not as low risk as they're built to be.
Mm.
So, with bond volatility. So I think the toolkit has been a problem. As Lewis mentioned before, the rise in interest rates to 4 or 5% has put short-term solutions back on the map. They were very difficult for a long period of time because interest rates were so low, and so you really had to kind of take some risk in that short-term bucket to generate any form of return. Yeah, I think having the toolkit is a big part of it.
Would you
It
Interested
also
to see.
go
Sorry,
on?
go
Sorry.
on.
I was to
Go on.
say, it also depends actually, because like whilst having the toolkit, there's layers, and that's an important part of it. Also, it does come down to tech and, like you said, the
Mm.
advice process, especially if you're working in, say, a network in particular versus if you're directly authorized. Some compliance companies may say, actually, we want you to use this piece of technology to do your investment recommendation. Now, we know there are tools out there that can really help look at things like the bucketing approach and these different goals for different solutions, etc. But some of them are really frustrating because they basically say, what's the client's risk profile? And it will only bring you solutions based on that risk profile. Won't you let it select anything else? So you could be trying to plan for a client that's moving house in the next couple of years, also needing to pay, say, if they're a business owner, pay a tax bill. They're also trying to plan for retirement, but you've got to put them all in an 8 out of 10 portfolio because that's what the risk profile suggested. So it does depend on the tools that are available, but also, yeah, what the advice process actually looks like from a compliance point of view, internally as well. So that and tech needs to be improved. We've maybe need to do a session on this another day, one about risk profiling in particular. But yeah,
So
it's
would you
bugbear
say
for
tech
many.
is at the forefront of one of the biggest challenges then when working with clients with multiple time horizons? Would you put tech as the number one blocker, if you like?
I would put it relatively equal. I think in terms of how you um, deliver the recommendation, I think tech can provide a huge support to that. But I think that's equal to making sure you've got the solutions kind of available to you to deliver on that.
Also,
Good stuff. So it looks like the overwhelming response is a sort of bucketing approach, so aligning to different goals and time horizons, which is entirely logical. Um, cool. Just briefly on Aspen, for those that aren't familiar, so we're MPS provider. That's what we do. That's all we do. Two financial advisors. We don't have any direct clients or anything, and we're looking to be best in class at that. And so, obviously, the MPS market is a highly competitive market. And so, launching a business in this space 6 years ago, you can't just be, the same as everyone else. You need to be doing something usefully different. So just a couple of bits on our edge. So we probably have the most comprehensive range of model portfolios on the market, and by that I don't just mean endless risk profiles. We have what we call our main range of portfolios, which there's 5 risk categories and 5 styles. And then we've pioneered the concept 3 or 4 years ago of the idea of satellite portfolios, and we'll definitely touch on those today. And they sort of deliver on more unique sort of client goals. Second point is the technology point. So we deliver our solutions through what we call portfolio discovery, which is a sort of a portal completely in the brand of the advisor firm to see the latest fact sheets, market updates, interactive charting about staying invested, why you would invest versus holding cash. Really useful aids with the client, as well as what we call something called portfolio discovery, which takes you on an interactive journey to build goals-based solutions for clients. We're definitely trying to move, the NPS sector towards more of a goals-based approach to investment rather than simply a risk profile approach to investment. We're very much conscious that the risk profiling side of things is part of it, but at the end of the day, we're delivering on client goals. Third is service, critically important, not just at point of sale. We are an extension of financial planning businesses on the investment side for anything you need as part of that. It doesn't need to be just related to Aspen. Anything you need to support the investment side of things of client conversations, we are here to do that. And you have a dedicated team of Lewis and his team, as well as the investment analysts that are there to support in a very timely manner. And then finally is our ability to be nimble. And this comes in two ways. So one is investment decision making. About a month ago, we called a meeting at 8 a.m. and changes were done by 10 a.m. We have an investment committee of 6 full time, as well as 2 people feeding into that, which allows for diversity of thought, but also the ability to make decisions. But also as a business, we're able to evolve and bring products to the market, improve our technology, get feedback, quicker than bigger firms. And when topical to this conversation, when interest rates went from 0 to 5%, we pretty quickly launched our Cash Plus and Gilts portfolio because there was a great opportunity to have those solutions in the market. So those are our differentiators at Aspen, and things are growing nicely in that respect. Right, coming on to more of into the detail of today's session. So we are of the belief that clients have goals, they have dreams, they have ambitions, and they have objectives, and they do not come to you to say, Hello, I think I'm risk level 5 out of 7. Have you got any solutions for me? That is not a typical conversation. So we're of the opinion that at the moment, so clients' needs are two-dimensional. They are risk and time horizon based, and they are goal based. And unfortunately, quite a lot of the products in the market in the MPS and multi-asset space really just focus on that one dimension of risk. And so sometimes it's a bit of a square peg and a round hole in terms of, and I think this is particularly true on the short time horizon basis. For 3 or 4 or 5 years ago, someone comes out as low risk or they need a sort of shorter term solution and they go into Vanguard Life Strategy 20. Vanguard's a perfectly good business and they have very good solutions. But there was a risk, an issue with this in the fact that the duration of their low risk portfolio and their bond component was about 8 years. And when interest rate rose, that fell by about 20%, which is not, in our view, a low risk solution. So, you're kind of fitting a bit of a square peg in a round hole there. So, we're of the opinion that you need, that versatility across a two-dimensional approach. And we're going to be focusing today here on that lower risk side of things and the options available there. Just briefly on our toolkit, so we offer 25 what we call main portfolios. That's 5 risk categories, 20, 40, 60, 80, 100 equity, and then 5 styles of portfolio: core, passive plus, income, sustainable, and multi-strategy. And then alongside that, quite very unique to Aspen, we offer our satellite portfolios. So cash plus, gilts, cap pres, Four Seasons, high income, global megatrends, and smaller companies. So that is our toolkit to deliver on risk profiles and goals. And today we're going to be focusing in this area in terms of the shorter term time horizons and the lower risk and the liquidity based solutions. So what are the types of circumstance for clients that require a liquidity solution? Shorter term goals basically fit into this camp, which is typically 1 to 3 years, 1 to 5 years. If a client comes to you and that's their time horizon, then this is obviously square in their camp. These are not generally suitable for someone with the pension and 20-year time horizon where clearly they need to be taking a good amount of equity risk. So there's just short-term goals that people typically want liquidity solutions. They might be looking for returns. They've got some cash in the bank and they're wondering, could I be doing a bit more with this money? Or they might be getting a poor return on platforms. I did see a recent document on the returns that people are getting on platform, and it's still not great on a number of platforms. And so I think one needs to be looking at alternative kind of liquidity-based solutions until such time the platforms stop carving out a little bit for themselves. So that's another one that is useful. Near-term goals, obviously short-term, near-term goals, but just a couple of examples here. So perhaps a house purchase that is likely to come up in 2 to 3 years' time. Perhaps a tax bill in 18 months that is coming, or school fee planning, perhaps a little bit longer out in the sort of 4 to 6 year time horizon. But they all kind of come in this bucket. Capital stability is important, but you perhaps want to inflation proof your money or get a bit of extra return than you get in the bank. And then finally is what we would call doubt money. People know they need to be doing something. They're not getting much return where they are, but they're just not sure about necessarily fully investing yet or what to be doing. This at least gets them, some of these solutions here can kind of get them invested without them having to worry too much about it. So those are the sort of client scenarios and types that would be suitable for liquidity or shorter term kind of goal-based investing. So we'll now look at the options available in the market for liquidity-based solutions. And as I said, I've got reasonable experience across seeing like thousands of funds across low risk to high risk over the years, and various products that have come and sometimes stayed and sometimes gone from the market. So I think the first option available and the most common has been the traditional portfolio, traditional low risk portfolio. So that might be an MPS or discretionary solution. Very typically, this has a high bond allocation, and if the duration, so that's the interest rate sensitivity, is beyond 5 years of this, it can come with it can come with volatility, as we saw in some of the passive strategies or active that held longer duration bonds, and there wasn't anything done during the 2022 period where we saw rates rise from 0 to 5%. So I think you need to be aware that even though the risk profilers profile them as low risk, they may not be that. So that's just something to be aware of. But now that rates are up at 4%, I think the risk and reward of these is much more balanced. So I think they're a viable option now for a low risk solution. It's relatively unlikely rates are going to go from 4 to 8, not impossible. We could return to a 70s type scenario, but it's relatively unlikely. So your risk and reward is much more balanced with these. I would have said avoid like the plague in 2021, but now they're a perfectly kind of viable option. But just be aware of the bond duration in that. Next up is absolute return funds. So over the years, last 15 years or so, these have sort of come and gone. Clearly back in, if it was 10, 15 years ago, everyone would have known and heard of Standard Life GARS, hugely popular solution in the market, and there was kind of equivalents that came off that. Seemed to kind of weather all storms and provide 8 to 10% relatively low vol returns until it didn't, and it started to go sideways and down a bit. So absolute return funds have been popular over the years, but they've come with their complexities and their sometimes unreliability. So Standard Life GARS went from 65 billion down to closing a few years ago. So that was that. There are others that have kind of stood the test of time. Like Ruffer, for example, now around for about 30 years. They've proved to do a very good job, in the early 2000s, during the financial crisis, during COVID, during the inflation era of 2022. They do go through some pockets of low or slightly negative returns, but they've been a pretty good safe pair of hands over the years. You've also got the Troy Trojan Fund and a couple of others that have been around for a long period of time and pretty sensibly managed. And typically these funds can have a low correlation to bonds and equities, so are quite a useful complement to more traditional portfolios that a client may hold of bonds and equities. So an interesting option, and not one that should be completely discounted just because GARS and its offshoots didn't work out. Next up is smooth funds, and these are pretty popular. I think obviously the flagship strategy here is the Proof Fund, and there's some variants that have come out off that. It seems to do a good job. Easy to communicate to clients. It's a nice straight line that kind of does its thing. I know it's a bit Marmite for people. Some people love the Proof Fund, some people don't. It is a little bit of an opaque structure for me. I wonder, if we do get a major downdraft, a huge volume of assets in this. There are quite a number of illiquids in it as well. So I don't know what might happen in that scenario, but it seems to be a perfectly good solution, and I'm sure they've got that that liquidity side of things well managed. And then finally, there's sort of ancillary options that are available. So you've got cash in the bank, that yields okay, or cash funds. So there's quite a lot of money market funds available on the market. So that's a viable option instead of platform cash. Just by there's lots of Aberdeen, BlackRock, they all offer sensible, good money market funds, and with those, you're really kind of looking to get close to base rates, net of fees. Then there's things like premium bonds, which are obviously useful and popular. Gilt portfolio, which we will touch on, and then structured products, which again have been a bit Marmite. They've come and gone over the years. I used to be structured product analyst as part of my role at Williams de Brasseaux, so I've seen quite a few over the years, and they're okay. But they're not for everyone. So those are really the options I think available on the lower risk. So I put these in the bucket of low, medium risk kind of solutions available on the market, and options where people just want to go a notch up from cash. And yeah, finally, and Lewis made this point, a lot of low risk solutions feed off base rates. So now that base rates are higher at around 4% mark, and it doesn't look like we're going to get any rate cuts now this year, it makes these much more attractive than they were, 5 to 15 years ago when rates were much lower. So, low risk solutions, you've kind of discounted them a lot over the years. And then obviously 2022 came and they were a challenge because, if in the incorrect structure. But now we're kind of through that, and I think they are very viable as options. So I think we have our second poll now, which is, where does most of your short-term client money currently sit? So where you do have short-term client money, where does that sit? So cash on deposit, either on platform or out with cash funds, money market funds, low-risk multi-asset portfolios, gilts or fixed income, or it depends on the client.
Adrian, do you think firms are being a bit too cautious with short-term allocations at the moment, or not cautious enough?
That's an interesting question. I think people have been scarred a little bit by, recent events of 2022 when rates went from 0 to 5, and you saw lower risk. Some traditional lower risk solutions, perform quite poorly in that environment. And then prior to that, they didn't deliver anything. So you've basically had, quite a long period of low returns and then a very difficult 2022. But we've now moved to a new regime that I think people should stay open-minded as to actually there's now like some genuinely viable options again in this space. Interesting to see the results here. Cash on deposits, fairly popular, as well as money market funds. So between those two, making up 50%, and then depends on the clients. Interesting that low risk multi-asset portfolios aren't really used much these days. These were popular over the years. I wonder if there's been a bit of a scarring from 2022 in that. So that is interesting to see that not so popular.
I think it's interesting as well because this shows at the minute it is just such a diverse mix because it kind of ties into that last option there, depending on the client lead. And I think this is a bit that we're seeing from a lot of people.
Yeah.
It really, like, the people that are asking, obviously today, obviously the people joining us on the call, like they're the ones seeing the clients, not us. So they're going to know their clients best and what this money's being used for. So actually, if you are looking to cater for clients that do have varying goals, it was interesting because we did see a lot of people adopt the bucketing approach, which does show that actually people are starting to allocate more money to short-term sort of cash, bonds, etc., low risk options now. Compared to say 10 years ago when interest rates were extremely low and those options weren't as attractive as what they once were. So I think we have seen a big shift, but I feel like we've probably only seen that shift over the last 18 months, maybe 2 years, where people have really started to adopt these solutions again.
Do clients generally understand the difference between these options, do you think, or is that still a challenge?
End client?
Yeah.
Oh, that's a good question.
I think it's just about like all investment solutions. It's about the explanation of the solution to the clients, and that's obviously the role of the advisor in that process. So there are more complex ones. I think that was thanks, James. That's really interesting. That makes sense. So yeah, I would say it's the a bit like equity solution or something else. I think the ability to explain it to the client. I think that was a big reason for Garza's demise. The Standard Life Gars, it got to 65 billion in size, and it was all well and good when the line was just sort of doing that. But then when it started to do that and trying to explain GARS, which was exceptionally complicated in terms of trying to understand, made it quite a challenge. And I think that was a big reason for his demise, that people were just like, you know what, I can't really explain why this is going sideways or down a bit. And so let's just move on. So yeah, as long as it's easy enough to explain, I think, clients can get it.
I think sentiment from advisors that we've spoken to as well, I'd say 80, maybe 85%. So that actually clients don't really care about what they're invested in there because there's their trust there with their advisor, saying that if you're telling me this is what I need for
Yeah.
this short-term solution, I trust you. There's
Mm.
probably, yeah, the remaining, say, 15% of clients that do want to go bit deeper and understand at least the fundamentals of the solution, which is why it is really important. And I know the FCA pulled us up on the retirement income review as well, especially some of the smooth products in particular. But yeah, client understanding is fundamental. If you can't sit there and explain it to a client in a really nice, easy to understand way, what's that going to do for the client's financial anxiety?
Yeah.
Cool. So just gonna dip
Oh, just
into.
quickly, I think we had a raised hand there.
Oh, that's
Did we?
nice.
I think I just saw one pop up, Lee. Have I made it up? Or...
No, you are right, Joseph. You got your hand up. I don't know if you want to come to the. No, he's gone back down. I thought it popped up earlier, and I thought maybe it's a
Okay.
mistake again.
Yeah, any
Cool.
questions, though, please let us know.
So yeah, I'm just going to briefly touch on some of our solutions in this liquidity space. So as I said before, we've got these satellite portfolios, and we have kind of four that fit in this low, medium risk side of things that are quite different from a conventional kind of low risk multi-asset portfolio, which was interesting to see that that's not so popular these days. So Cash Plus, Gilts, Cat Pres, and Four Seasons really fit in this category. We have some other ones, high income, smaller companies, and global megatrends, which do not. So just going to spend a couple of minutes on each of these, just to kind of explain, what is possible on the lower risk side of things, using a relatively conventional way. There's always a concern. Suresh, thank you for this. There's always a concern as a financial advisor to focus on the term. I think you mean by the time horizon there, and that is the critical importance of the decision of if someone's able to take risk is their time horizon. That is the most important thing. So yeah, so Cash Plus, obviously we saw on the poll that cash-based solutions are popular. Over 50% use either platform cash or a money market fund. So this is basically the equivalent of that wrapped up in a portfolio. So the aim of our Cash Plus portfolio is to provide a return net of fees at base rates. With a clear focus on capital preservation. And it uses a blend of four money market funds and then two ultra short dated bond funds. And so that net of fees gets you to base rates. And it's really ideal for those that, just need a cash home, daily liquid, and have obviously a very low tolerance or capacity for loss for this pot of money. And so this is Aspen Cash Plus against Bank of England base rates, doing everything you would expect as it says on the tin, so very close to that of base rates net of all fees. So that is, I think, a viable option where platform cash isn't delivering. But equally, if you have a favorite money market fund, by all means, look at our fact sheets and pick one of those. They're good funds, or you can just hold a portfolio like this. Next up is the gilts portfolio, which is a little bit more technical, but a really interesting solution. It's actually come back on the map in the last few weeks with short-term rates moving back up quite considerably in gilts. So this is it was one of these no-brainers about 2.5 years ago, and then short-term rates were sort of slowly coming down, and now they've kind of done that again. So this is a really interesting solution back on the map. So it gives exposure to short-dated, low-coupon UK gilts. And the interesting thing about this is over the 2010s and early 2020s, when rates were very low, the government issued debt at very low coupons. I think the lowest one was, I think, 1/8%, if you can remember when base rates were that low. So that was, and what was interesting then, when rates rise, the value of these bonds falls. And so what you have is this unique scenario. The gains on a gilt is free of tax. So as it pulls to par, that gain doesn't attract any tax. It's free of capital gains tax. And so if you buy low coupon, short dated gilts, you benefit from that pull to par as they move to maturity. And so it's a really nice solution for higher rate taxpayers versus having money in the bank, which is obviously taxable as interest. And so this is the popularity, particularly for higher rate taxpayers, of the gilts portfolio. So this is the gilts portfolio that we run. It does have little bits of volatility in it. I think the drawdowns have been, no more than 1.5% over the last 3 years. Obviously, the most recent one in the last month was an interesting case study. We're almost back up to where it was 2 months ago. But when short-term rates really reprice, we get a little bit of a drawdown there, but it's certainly not permanent loss of capital because we hold all our gilts to maturity. So that just puts, I think this little drawdown that we've seen here puts it back as a really interesting kind of option in the market. And it's important to remember that when one thinks of gilts, one thinks of bonds flying around all over the place. So this is the standard gilts index. So you can get all sorts of, and if I extended this back to 2022, a near 20% drawdown in this. That is not what this is. The gilts portfolio is very focused on the short term, the short dated bonds. So that vol that you get in the wider market just isn't evident in the gilts portfolio. So that's just something to bear in mind. You're not buying conventional gilts. You're focused very much at the short end. I'll just give a little case study here of holding a gilts portfolio versus a savings account. So let's say, quite a large sum here, but let's say someone wanted to deposit, they have a higher rate taxpayer, they have £500,000 that, it needs a short-term home. And let's say the yield on the gilts portfolio is around 4% and the yield in the banks around 4%. Your actual net of tax return from this is around 19,000 net of fees in the gilts portfolio versus around 9,600 of money in the bank after tax. So your gross equivalent yield, that basically the yield you'd need to get in the bank to equal what you get in the gilts portfolio is actually slightly in excess of 7%. At the moment. So, if you saw on the bank, you could get 7% with daily liquidity, you bite someone's hand off for that. So it's a really nice alternative to cash in the bank. And as I say, it's daily liquid. There are some other products in the market called gilt ladders that other providers offer. You don't quite have the liquidity there, but we've structured ours that it is offering this sort of daily liquidity there. So I think a really interesting solution in the gilts portfolio and one to certainly consider. Next up is capital preservation. So this is sort of one level up, I would say, from holding cash, money market funds and things. And basically the aim here is looking for cash plus 1, cash plus 2%. So capital preservation is still a major focus here, but we are just looking for something a little bit more than cash. Perhaps we're looking to inflation-proof this part of the portfolio. So maybe the time horizon for this is in the sort of 2 to 5 year cap for this sort of money. And this portfolio is constructed using money market funds, short-dated bonds, and around 20% of our preferred absolute return type strategies. So we have Troy and Ruffer in here for these options at the moment. And so this is the performance of that strategy over the last 3 years or so. So as you can see, so red line is base rates, and we're looking here to really have a relatively low volatile kind of approach to this. Obviously, we've seen a little bit of a drawdown recently to the tune of maybe 1.7% or so, and that's obviously the repricing of short-dated bonds has done that. But again, we're now back in positive territory for the year, so no major damage done there. So I think that's a one level up, just a little bit more going on and a little bit more return potential from that. So those are the three what I call risk level 1 solutions, and 1 out of 5, 1 out of 7, very much cash like or just a little bit more options in the market. I just want to finish on in terms of solutions from Aspen. What I kind of describe as risk level 2 in terms of out of 5 or out of 7, where you're wanting a little bit more kind of going on. You're really looking to inflation proof the client assets, and this is probably with a 4 to 7 year time horizon. So if anyone has perhaps school fee planning or something, that duration out, or they know they've got some expenditure and they want their money doing some work, then this is quite suitable. So Four Seasons is a flagship offering from Aspen, and really is a portfolio for all market environments. And so just briefly, I'll rattle through this in a few minutes. A portfolio looking to preserve and grow the real value of capital by balancing the two primary drivers of assets, which is growth and inflation, either moving above or falling below trend. And it uses a tried and tested blend of bonds, equities, commodities, and gold. So no shorting, no market timing, just a sensible mix, fully diversified portfolio of assets with the aim of delivering a relatively smooth return profile over time. So as I said, typical investors in this, those seeking to preserve their money against inflation, those perhaps approaching retirement in what's known as that lifestyle phase, those perhaps in pension drawdown if you use the bucketing approach for that middle bucket, that sort of 3 to 7 year time horizon, those seeking a home for excess cash, those perhaps with a relatively low attitude towards risk, and those that, coming back to that doubt money piece, they only need to be doing something with their money, but they're a little bit of a nervous investor, or they don't think it's the right time. This just gets them invested. So these are the typical kind of client segments that would work for Four Seasons. In terms of how it's built, so any market environment we find ourselves in can be put in one of 4 camps. Either growth is going above trend or below trend, or inflation is going above trend or below trend. So spring is a disinflationary boom. That's the mid-80s, the 1990s, and the 2010s. Growth is above trend or relatively strong, and inflation is low. Summer is an inflationary boom. Inflation starts to move above trend, and growth is still relatively stable. So this was 2022, basically. Here you want to hold value stocks, EM, commodities, these sorts of things. Autumn is stagflation. Inflation is above trend, but growth is starting to go below trend. This is what the market's been anxious about recently. So the 1970s and the early part of the financial crisis. For those that remember 2008, remember the oil price in May, June, July, really spiking to about $150 a barrel, and that preceded the financial crisis. So stagflation is not a good environment, and that's what people have been a little bit anxious of in the last few weeks. And then finally, winter is a deflationary bust. This is the scenario we all want to avoid. That's the Great Depression of the 1930s, the financial crisis, and the early part of the COVID pandemic. Growth is falling dramatically below trend, and inflation is lower, falling as well. So that's a particularly bleak environment. Fortunately, we spend most of our time in that green scenario. I think around 45% of our time is there. So that is good. But those are the 4 environments of markets that we find ourselves in. So we look at what assets do well in each of those 4 environments. In that good environment, we want to hold stocks and corporate bonds. When inflation's rising, we want to hold value stocks, emerging markets, and commodities typically. When inflation's rising and growth is starting to fall, we want to hold inflation-linked bonds and gold. And in that bleak environment, we want to hold various duration of sovereign bonds, cash, and min-vol stocks if we're holding stocks. So in building the Four Seasons portfolio, we want to allocate 25% of our risk to each of these 4 environments. We have no idea in 6 months' time whether a recession's coming, whether there's another war, whether there's a good market, bad market. And so we want to be fully diversified across all scenarios. And that equals this asset mix. So cash, bonds, equities, and commodities, including gold. But you see within fixed income and within equities, we have proper diversification in there. And the really interesting piece within equities is the style factors that you have in there of min, vol, value, quality, and size. These all fire at different times, but over the long term go up. And then a good allocation to commodities and gold to protect a bit in that inflationary environment. And so if we look at those assets, so those line items on the right there, this is what they look like over the last 35 years. So, they all kind of fire at different times. They all go up. So these are all long-only assets. I'm not a believer in shorting, market timing, these sorts of things. I think they can work momentarily, but then are a drag on portfolios. But these are those assets over the last 35 years. All go up over time, but fire at different times. And the allocation we've set in Four Seasons is to blend these in such a way to deliver on that relatively smooth return profile that we are looking for. And if we look over the last 50 years net of fees, it has delivered a pretty stable return, around 7% net of fees, far less than half the volatility of equity investing, and not recorded a loss over a 3-year period. And these are the sort of discrete annual returns from that as well. We've been running the Four Seasons fund, so it's a fund and a portfolio for over a year now, and we've had a couple of tests in it, which has been good. First was the tariff tantrum, and more recently the Iran war. And the strategy is definitely living up to what we hoped and expected, around a 15% return over the last year and a bit, and far less than half the vol of equities. So I'll kind of stop there, I think. So that's just what the Four Seasons portfolio looked like. It's all about asset allocation. So it's largely using index funds to populate that asset allocation. So the underlying cost of funds is only 20 basis points. It's all about that asset allocation exposure, keep costs down and kind of deliver on that. We were going to go into a little case study, but I think I'll just pause there for a moment just to see if there's any questions. And if not, we can do a sort of 5-7 minute case study. Dominic, thanks for your question there. Cash Plus available on Fundament. Yes, it is. As is the Gilts portfolio, I think, Lewis, because Gilts isn't available on all platforms. I think around 5 platforms. It's there.
Yeah, it's Fundament's definitely on. We've got about 15 platforms are on altogether, the portfolios. So yeah, all the ones you mentioned today will be on most. Gilt's the only one that's on about 50% of them, and they're not on the other 50%. But if you wanted to ask any questions around that and what platforms you're using, please let us know. More than happy to obviously go through that in a bit more detail.
Yeah, we're on about 15 platforms or so, and all the portfolios are on all these platforms except Gilts, which is only on about 5. Not all platforms offer the ability to hold direct Gilts, so that's good. Yes, so there's no immediate questions. Here we go. James, presumably you don't spend the same amount of time in each season. Have you considered time weighting the strategy? It's an interesting question. Yeah, I mean, a lot of analysis done on the asset mix and Royal London, who have Jeremy, not Jeremy Grantham, I'm seeing him tonight, who does GMO. He's actually presenting, which I'm really looking forward to, over from the States. Trevor Greetham, who runs the Royal London asset allocation. They're their investment clock, which looks to try and navigate through the different environments. And if we are more in that good environment, then we have more of our assets in there. What we've done with Four Seasons is we have a slight leaning to that spring environment where we spend more of our time, and so it does have a slight long bias to equities rather than pure risk parity, as is known how Bridgewater in the US have created their all-weather strategy. So we recognize that we spend a little bit more of our time in that environment, and so let's lean into that a little bit in the strategic asset allocation. We then try not to time what environment we're in, because you can very quickly flip from one environment to another, and we try not to sort of time and react to that. We try to insulate against all environments, and by holding long only assets, if we spend most of our time, 2010 to 2020 was pretty much much bonds and equities going up. This strategy did great in that in environment. So thanks. That was an interesting question. Are ethical funds a not quite consideration? There we go. So we do have a sustainable range. So I'm not sure if you're talking specifically about Four Seasons or just generally. So we have a sustainable range of portfolios. We as a business, we sit in the light green camp rather than dark green. Light green is what I call financial returns and money being managed responsibly are equally important. It does mean there's still a bit of energy in there, which actually I think people quite like these days. They didn't like it in 2021, but I think they quite like having a little bit of that now. As long as they're in the businesses that are, doing good in the energy transition space. They're still obviously oil and gas producers, but they are, investing into energy transition. And I think complete divestment out of energy is probably not a solution for the world. So that's the camp that we sit in. As for Four Seasons, we have a ESG framework by which we look at all funds in the portfolio, and that excludes 5% of the market, I would say. But there isn't a direct kind of ethical screen within Four Seasons.
Just on that point, if we've got a couple of minutes, rather than obviously go through the case study and the slides, because Lee mentioned earlier around sort of limitations on some of this stuff as well. Tech does play a part of it, so I'd be happy to finish off the last couple of minutes if you want to just go through the case study on our tech, just to sort of show you what that looks like and how you can sort of model these for clients if that helps.
I think that'd be good.
Yeah. All right, cool, perfect. Right, let me share my screen.
This is where I get an update on your tech as well.
Can you see that okay?
We can indeed.
Yes.
Right, fantastic. So I think Lee, I'm glad you brought this up earlier. It's almost like you've seen this before, which is why you brought it
By
up.
the way, I haven't.
Yeah, it's a really interesting part. So this is a big issue that I think a lot of financial planners are coming to us and saying we want to use different solutions for this more goals-based investing approach. But how can we bring this together in a way that not only our clients understand, but when we're submitting these reports and recommendations to our compliance teams, to power planning, whoever it may be, how can they understand what we're building and why? So we've basically developed this, which is the Aspen Portfolio Discovery Tool, and it will help streamline that investment selection journey for the goals-based approach for you. It can be in Aspen branding, but it can actually also be in your branding completely as well. It's a complimentary bit of kit. We don't charge you anything for it. Anyone using any of our portfolios gets access to this as well. So you've got fact sheets, market updates, everything you need, but just in conscious of time, I'm just going to go straight into the journey as part of that. So if we go through the guided portfolio builder journey, what we can do, if we then say, Lee, you're going to be our client today, we're going to assign a risk profile for you in just a moment. But if we then say, right, I've got Lee here, I need to start adding some tax wrappers for him and some assets we're looking to do the recommendations for. So using the different tax wrappers available to us, let's just say actually to start off with, you might just generally have cash in the bank. And that could be £150,000 that you have there. You then might have, say, an ISA, and let's just say that's going to be £200,000. And let's also give you a pension, and that pension will be worth £650,000. So get to £1 million, nice round numbers. So once we put the solutions in that we're looking to provide a recommendation on, we can then start to look at, well, Lee, what are your goals? And this is a more real world example of the conversations that we're seeing our clients have and financial planners out in the marketplace. So we can now start to create our own goals for the client. And you might say, actually, well, goal number one is going to be a house purchase that I have coming up. And that's going to be in the next 1 to 3 years. I'm then looking at school fee planning, because that's a popular one that keeps coming up at the minute as well. And let's say school fee planning is more medium term. So that's going to be in the next sort of 3 to 7 years. And lastly, I'm also going to look at doing some planning for retirement as well. And that's going to be 20 years away. So we just put over 7 years. So now I've identified my 3 goals. We can now have a conversation around risk, but using this as a starting point for the conversation. It's not going to be the be all and end all. It's not going to be a matter of you can only go into these solutions that count this risk rating. So let's just say that we've got a 4 out of 5 risk profile. So we've got time on our side, but we don't want to take too much risk because actually we have got some shorter time horizons that we're looking to meet here as well.
Lewis, just so the drop down of the external suppliers in terms of that's quite useful. So if you are risk profiled by other providers, you can simply just map those very simply if you use eValue, Dynamic Planner, De facto, or we have risk profiling software, so you can just easily map those across.
Yeah, it's a good point. And it's important that this fits into your process and what you're currently using already. So now I've got my risk. So I've got these named. He's coming out as a 4 out of 5 for risk when we look at mapping that across. We've got our appers here and we've got our goals. So now let's try to meet these goals and objectives with the correct solutions for those. So house purchase, we don't, as discussed today, we don't want that to be too volatile. So we're going to use that cash in the bank that we spoke about initially. However, cash in the bank's not very attractive at the moment. Let's use Dominic's example and say this is going to go onto the fundament platform. Let's look at Cash Plus for this particular solution, and let's put the £150,000 in cash and earmark that for the house purchase. So what this tool's starting to do, and you can hopefully see this on the bottom left here, it's starting to calculate your aggregate risk profile and aggregate cost overall. So it's using that risk framework that we looked at earlier as a guiding point of the conversation, but it's not limiting us in terms of the solutions that we have to use. And this is then much more real world example of the conversations we're seeing a lot of planners have. So we then got school fees. So we're going to be accessing that money somewhat soon, but we've still got time on our side. So we want that to grow. We want that to ideally grow above cash. So let's just use the ISA here. And let's just use the Four Seasons portfolio in there as well. And that is going to be the £200,000 we spoke about right there. So we've got the £650,000 pension left to allocate. And we know because this client's only 45 years old, we've got 20 years before they go into retirement. Time's on our side. We want to be taking risk with this solution. So because we're actually taking quite a lot of low risk at the early part of the client's goals, well, what we can now do, if we look at adding a pension to this long-term pot, we can then look to increase the risk because we do want the client to really maximize their growth to give them really sustainable income when they go into retirement. So let's go with the equity focus passive plus solution in here as well. And let's allocate the remaining £650,000. So now the warning's gone. So I've now at least met my client's agreed risk profile, but I've done this in a more tailored and personalized way to them. And it's brought into consideration that I am taking lower risk for the first 7 years. And actually, as a result of that, I can now start to increase risk with my longer term pots because actually there's two completely different goals and doing two completely different things. So all-in cost for this more bespoke, more tailored solution is only 0.36%, and that's including Aspen's underlying investment fees for the funds that we use, as well as our DFM fee as well. So add it to a fundment who maybe for this sort of client we maybe charge 10 basis points, maybe 15 basis points. You've got the investment and platform all in a more personalised way for less than 15 bips altogether. And what our tool can then do to help with your own compliance teams and power planning teams, as mentioned, you can download a report and it will then document everything you've just gone through in detail, the goals, the solutions we're looking to align, and the rationale behind why we're doing that as well. So this is what then will be produced. So it talks about how we work with you as the financial advisor, how you work with the client, this money we were looking to do the investment recommendations for. I've got my client's goals here. I've got the agreed risk profile. And then it's got the recommendation split by goal instead for us as well. And it's automatically pulled through all of the fact sheets for the solutions that we've populated as well. This is just an example, by the way. You don't have to use Aspen solutions on the tool entirely. We can actually look at adding third-party solutions in there as well. So if you wanted to use, for example, Cash Plus, Four Seasons, then they're like a Vanguard 100% equity life strategy, you can also do that as well. So the satellites don't have to be used with one of the Aspen main ranges, but it's just a good example of how they can work together.
Great. Thanks, Lewis. I think we've just run over by a couple of minutes. Apologies for that. Lee, back to you.
Yep. Thanks, guys. That was really good. It's good to see the tech. As I said to you, every time we do a bit of a tech demo, I see it grow a little bit. You know, if we go back to the very first webinar we run with you guys, Suresh said, brilliant bit of tech. And it is. It's just developing and growing arms and legs every time we see it. So kudos to your tech team and the guys that are coming to the forefront with the ideas. As always, we've run over it by a couple of minutes, so I do apologise, but we wanted to get that little tech demo in place. As I mentioned, when you exit, if you can give us some feedback on today's session, the content that's been delivered by Andrew and Lewis. If you require CPD as well, do let us know. If you've got any further questions, now's your time. A lot of guys are thanking you both. Good content, good bit of tech. So well done, guys.
What we'll do as well, and I really appreciate everyone's kind feedback there, and thank you for the engagement today as well. It's really good to see, especially the polls being answered, the variety of different answers. But with the follow-up, we'll send slides over to everyone.
Perfect.
We'll send the platform availability as well, because I appreciate that's come up. And also the portfolios that we mentioned as well, we'll make sure that's included as part of that. And yeah, I think CPD's been sent by you, Lee, isn't it?
Yeah.
Yes.
Leah, you organise. Yeah. Brilliant.
Yep. We'll get all of that sorted for everybody. Yeah. Sean, Dominic, CPD is on the feedback, guys. On the feedback form, when you exit today's webinar, a feedback form will pop up. At the bottom of the feedback form, it will say, do you require CPD from today's session? Hit yes, and that'll automate everything our end to get CPD certificates out to you. Good stuff. Brilliant. What I'll do, I'll just stop the recording.